A question you might be asking yourself is, why does one company trade at a much higher multiple relative to one of its peers? Same industry, same sector, selling the same product, but maybe one company trades at 20 times earnings and another company trades at 15 times earnings. A lot of the reason comes down to the profitability and the efficiency of its assets or its equity. In today's update, we're going to look at the return on assets and the asset turnover ratio to try and give us a clue as to how profitable a business might be. And then we're going to look at a very pragmatic example considering the profitability of McDonald's versus restaurant brands and then comparing the performance of both stocks since inception for restaurant brands. Let's get straight into it. For this example, we're going to be analyzing two different businesses in the same industry. We want to know which company is optimizing its assets better for profitability and net sales. And in order to do that, we're going to be looking at both the return on assets or ROA and the asset turnover ratio. But before we look at both of those companies, it's very important that we understand what these metrics are, how we calculate them, and some of the drawbacks we might experience with them. Every metric is different and not every metric is perfect. So it's very important that we understand the nuance behind how these are calculated and some of the challenges that we might experience with them. The two ratios that we're going to be looking at is return on assets, which is net income divided by average total assets. And we're going to look at asset turnover ratio, which is the net sales divided by average total assets. I personally prefer a company that's optimizing its assets for profitability, so I prefer return on assets as opposed to asset turnover, but there's no harm in understanding the difference between both. Now let's start off with average total assets. What is average total assets? Well, in order to calculate this, we want assets in the current year. For lack of a better phrase, I use the current year, so we're looking at McDonald's balance sheet. 2021, we're taking the assets, and we're adding that to the prior year. So assets in last year. For lack of a better phrase, I just put LY in there. So we're adding both of those together and we're dividing it by 2, and that gives us the average total assets over the past 2 years. And we're dividing net income into the average assets. Very, very, very simple ratios. And what this is telling us is, it's telling us, in terms of return on assets, the profitability relative to its assets, and asset turnover, the amount of turnover in terms of revenue you're making per year. So this is displayed as a ratio, and this is displayed, it could be displayed as a ratio as well, but it's displayed as a percentage. So what are some of the challenges with this? We know that it's a profitability metric when we're looking at return on assets, and we know that it's more of an efficiency metric when we're looking at asset turnover, but what are some of the drawbacks? Well, we're looking at total assets without any consideration into what those assets are. And as we mentioned in the balance sheet update, there are some assets on the balance sheet that are a little bit erroneous. And in this case, we have goodwill. Goodwill at $2.7 billion might inflate the assets, and that might give us a sort of lower return on assets relative to what the true assets would be if they were to mark that goodwill down. Because it's very difficult to turn that goodwill back into cash or convert it back into some sort of tangible asset. Below there, we've got other intangibles. We may not know what they are. Now, intellectual property in the case of McDonald's is very valuable. In the case of Coca-Cola, it's very valuable. But maybe something that is no name, no brand, the intellectual property, which might be trademarks or whatnot, may not be as valuable. We really don't know what that is. And so that's sort of up for question as to whether that's actually driving the profitability of the business. Really comes down to what those other intangibles are. It's likely intellectual property. And then finally at the bottom here, we've got other long-term assets. Those long-term assets might be investments in private businesses. And they might be mismarked. Mark to market, it might be priced at, let's say, $1,000. But if you were to float that on the public market today with a lack of liquidity, it may only fetch something closer to $500. And so these long-term assets may not be correctly marked to market. And so there's some of the challenges when we're looking at average total assets. So it's not a perfect metric, but it will give us some sort of idea on a relative basis how profitable the business is and how much turnover, how many times revenue turns over relative to its average asset per year. And both of those give us an idea of efficiency relative to one of its peers in the same industry. If you have McDonald's versus restaurant brands, same industry, same intra-sector industry, one company might be more profitable than the other, and that might show up in the performance of the stock irrespective of the multiple that's paid for it. Profitability is very important. So let's pop on over to Ticker Terminal. We do have a link in the description below if you're interested in using Ticker Terminal. It's a fabulous resource. I love it. I spend most of my day on Ticker Terminal. So we're going to search for restaurant brands, and we're going to compare restaurant brands in terms of return on assets and asset turnover to its peer, McDonald's. And we're going to understand which one is more profitable, and then we're going to have a look at the performance since inception of restaurant brands versus McDonald's to see if the profitability adds up. So if we go down here, what we have, if I hold over here restaurant brands for return on assets, on average since 2016 we've seen roughly 5 to 6%. Now if we have a look at McDonald's, we're seeing somewhere between 12 or somewhere between 9 and 16%. So when we're looking at return on assets, McDonald's is in some cases 3 times more profitable relative to its assets in terms of optimizing those assets versus restaurant brands. It means that McDonald's is far more efficient in squeezing out profits from its assets. In the same sector, that's pretty relevant. We would want to own at the right price McDonald's over maybe restaurant brands based on this metric. But of course, an analysis has to be an awful lot deeper, so we got to look a little bit further under the hood. This is not enough just to make a decision, but it does give you some clues. Over here we got restaurant brands, asset turnover. You can see since 2016 it's anywhere from 0.22 all the way up to about 0.27. When we look at McDonald's, it's anywhere from 0.36 to about 0.79. So the asset turnover, they're turning over revenue twice as fast as restaurant brands. So in this circumstance, when we're looking at return on assets and we're looking at the asset turnover ratio, we would want to own McDonald's over restaurant brands, of course, at the right price. And what's interesting is when we mark out both of these performances since inception for restaurant brands back in 2015, you can see restaurant brands has delivered 76%, whereas McDonald's is up 209%. Now that's not solely driven by the return on assets, but the return on assets has given us a clue that the profitability of McDonald's relative to its peers is a lot higher. Of course, there has to be deeper analysis, but that's one clue in which we could understand that McDonald's is a better run company based on its profitability metric, looking at return on assets and asset turnover. If you're interested, we also cover other profitability metrics such as the return on invested capital and the return on equity here on the channel. Thank you very much for your support and have a great day.